Dear clients, I'm Richard, Senior Dealer from Phillip CFD. Major US indexes retreated from their record levels amid winter-chilled US economic data and concern over the timing of a rate lift-off by the Fed. However, losses were mitigated by a strong rally last Friday post-April FOMC meeting on the back of Fed's reassurance that the weak patch was transitory, and given that the removal of prior calendar references, the rate hike decisions will be data dependent. As a result, although Dow Jones Industrial Average 30, the S&P 500 and the Nasdaq Composite were down by 0.3%, 0.4% and 1.7% respectively for the week. Good news is that the US indices still managed to hover around their respective psychological level of 18,000, 2,100 and 5,000. Now let's discuss on the economics calendar. Investors were sandwiched between disappointing 1Q economics data but more encouraging numbers from the US employment and consumer segments. Indeed, investors' knee-jerk reaction to last Wednesday's release of 1Q15's US GDP annualized growth rate, which came in at a much worse than expected 0.2%, was to scurry for cover. Nonetheless, subsequent releases of more forward-looking data saves the day, as better than expected weekly jobless claims numbers and April's consumer sentiment gauge staying at an elevated level signals that US consumer spending should stay on track. Next, let's get up to date on the 1Q15 US earnings seasons. We are already past midway and earnings momentum seems to be on a positive tone. According to data and analysis firm FactSet, overall reported earnings for companies in the S&P 500 index were on track to fall a much smaller than expected decline of 0.4% in the current quarter. In terms of the cross-asset actions, the selling pressures experienced in the sovereign debt markets have been quite headline-grabbing. In fact, the yield on the 10-year German bond surged to almost 0.4%, the highest in about 7 weeks, and 10-year US Treasury yield was lifted along up to more than 2.1%. Bonds prices and yields are moved in different directions. The key takeaway here is that deflation fear in Europe may have substantially eased, and that we may start to see fundamental improvement in the Eurozone economies. Furthermore, during the month of April, the twin headwinds facing US multinationals, namely an overly strong US dollar and falling oil prices, also abated, which bodes well for a recovery for their overseas earnings contributions. In summary, I believe that investor confidence should be shored up by a broadly constructive macro environment. As such, buy the dip strategy may continue to be rewarding, barring risk scenarios such as Brexit that could spark a market correction. Meanwhile, investors may also take note that April's non-farm payroll will be released on this Friday, which is an indication on whether or not the 1Q slowdown could continue into the rest of the year. Clients may consider using Phillip CFD to trade equities and index or cross markets to capitalize on trading opportunities in both rising and falling markets. In addition, you may also trade on different strategies using many more benchmarks, which are available with Phillip ETFs. With that, I've come to the end of the presentations. Thank you for watching this week's Market Watch. Please subscribe to us on PhillipCapital YouTube channel and Facebook. Stay tuned for more Market Watch videos.